there. Welcome to The Close. I'm Lindsay Biscaya. Markets will be closing in half an hour from now. But first, let's get to some of the other stories we're following for you in the BNN Bloomberg newsroom. Canada's inflation slowed last month. Data from StatsCan shows the annual rate of inflation ticked down to 2.3% in January compared to December. Economists were expecting CPI to remain steady at 2.4%. Gas prices also saw a slowdown, while shelter prices fell below 2% for the first time in nearly 5 years. Some analysts believe even though the report shows signs of inflationary pressures easing, it's unlikely to sway the Bank of Canada. Prime Minister Mark Carney says Ottawa will invest billions in Canada's defense industry over the next decade with its new Defense Investment Agency. Speaking at an event, Carney says Canada will spend $470 billion on military procurement, as well as defense and security infrastructure. Carney says the new agency will boost exports, grow industry revenues, and raise acquisitions. He says the framework is to build, partner, and buy.
Defending Canada means more than just increasing the size of our military. It also means the strength of our industries, the resilience of our economy, and our capacity to act independently when it matters the most. We will build in Canada and prioritize Canadian companies. As a matter of policy, military procurement in areas where we have sovereign capabilities will be directed to Canadian firms first.
And Canada has signed a preliminary trade agreement with Mexico. Minister of U.S. Trade Dominic LeBlanc says Canada and Mexico will work to expand port-to-port trade and will also hold talks on security. LeBlanc says Ottawa also sees investment opportunities in the pharmaceutical and agricultural sectors. The delegation is in Mexico until Friday. We'll take a look at the markets this afternoon. The TSX is down by 0.6%, thanks to some weakness in base metals and energy stocks that we're seeing today. If we take a look south of the border at the U.S. markets, it's been an interesting day there. All trading up, rebounding from earlier losses today. We'll continue to dig into that. Well, Canadian markets are down. U.S. stocks are muted to start the week, a shortened trading week, that is. And joining us now with some stocks to watch is Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. It's good to have you join us. Thanks so much.
Thank you, Lindsay, for having me.
So we'll get into the stocks to watch in just a moment, but just like an overall look at the markets today. Obviously, we're seeing U.S. markets bouncing back. You say markets are in a discovery mode. What do you mean by that?
I mean that it's not as clear as it used to be in the beginning of the year and at the end of last year, when there was clear rotation going out of technology into other sectors, undervalued, cheaper, commodity-driven. Everything was continuing in 2026 as it was in 2025. What we've had in the last 2-3 weeks is a period of discovery as commodities starting to consolidate a bit. I don't think it's any more sinister than that. But some of these commodities like silver, for example, are very, very volatile. And a couple of weeks ago, we had a Friday where it cracked to the tune of 30% in one day. And that was 30% that they rallied 14 days before that. So 14 days up, 14 days up, 30%, one day down 30%. That's the kind of volatility that gets people to rein in their leverage. So what we've seen mainly is the highly levered sectors have also gotten hit. And then slowly, the rotations did not happen. Sometimes the financials got a little weaker than other parts of the commodity market. So it's not as clear. It's in discovery mode where these commodities are going to find support. In the meantime, we have China closed for Lunar New Year. So we have a demand out of the market. We'll see where they settle. But that's what I mean by discovery mode.
Okay, now you have 10 to 15% of your portfolio in cash, you say, and you may be looking to exit some more positions. What areas would you exit and why?
Well, the way we do things is that we have a saying, price does have to match the narrative. So, for example, we've had earnings season. Some stocks reported some excellent earnings, and they just didn't act well. So we've exited a large money center bank. We've exited technology stock. We're pretty underweight technology to begin with, but we had about 4 positions. Now we have 3. If the stock reports really well and the narrative is really bullish, and then it sells off 10, 20%, 30%, that doesn't bode well for the stock, near-term future. And in order to decrease the volatility in the portfolio, there's lots of other places to be in. You don't have to be in the ones that are so volatile. So we've taken down as the prices hit our threshold of pain, let's put it that way, or, not stop loss per se, but levels where we're not willing to see the stock go lower. We put it in our farm team, and then we'll see as we may re-enter them at a later date when it's less volatile.
Now, we do have some gold and mining stocks reporting results this week. Are there any particular ones that are a favorite for you or anything you're watching for in terms of certain companies that are reporting?
Yeah, so we've exited a lot of our precious metals exposure a couple of weeks ago. We still like the theme, but the metals have rallied a lot and fast, and the period of consolidation, like I just mentioned, is not out of the question. So we'll re-enter in due course. But in the meantime, we have many of our stocks, those stocks in our farm list. One of them that we did keep is Agnico Eagle. And the reason for that is really record production, strong free cash flow, continued cost discipline, and, it's in areas that are geopolitically safe. Dividends, share buybacks, it's all there. So it's a large cap, don't really need to move down the capitalization pipe there, reported already, and it's acted well.
You also like Caterpillar, which beat estimates recently. It's also doubled in the last year, its stock price. I wonder, with Caterpillar, how much further do you see in terms of growth for that company?
You see, this is what I mean, though, when we say that we want to make sure that pricing acts the same way as the narrative. So you do take a company like Caterpillar, and they already reported, so that risk is out of the way, and it acted well. And it's in the right sector, like industrials. But for example, should it not have acted well, and you're holding it for the last couple of years, you would have had great profits. You may not catch the top, but if it was to sell off, there'd be a level where we would say, okay, we're going to take some profits, put it in a farm list side, and see if we re-enter again. We still like Caterpillar. Caterpillar is characterized as an industrial, but it also has a connection to the power theme. They make natural gas turbines that go into powering data centers, which is really in play. It's really a high margin, high growing business. And in their latest report, they said that power and energy segment posted a 44% profit. And it acted well. It traded the way that the narrative was supposed to make it trade, unlike some other companies when we started our conversation today that we exited that just had great reports and did not act well.
For sure. Okay, so we talked about precious metals. I'm wondering, when we're talking about investors and being cautious in this environment, when it comes to the price of oil, I wonder where you see oil going this year. Do you have any companies within that sector that you're feeling bullish about?
Yeah, so the energy sector has been really in play, and despite the fact that oil is not at some incredible high, despite the fact that we have some geopolitical stresses out there, the stocks have been acting really well. So we have exposure through mainly the large caps, CNQ, Suncor, Imperial Oil. These are, again, acting really well. You don't have to go down the capitalization curve. You can really get exposed to the largest of caps with the buybacks and the balance sheet discipline and very strong free cash flow and dividends. I mean, CNQ has really low production costs and very strong free cash flow. Suncor has both upstream and downstream, allows them earnings insulation when crude prices are volatile. So the world cash flow is flowing to this sector, mainly because, the macro is pretty good. Mm-hmm. And I wouldn't discount the fact that Canada is part of the global trade. So, there is a trade that, says that maybe ex-US is perhaps a place to be. Portfolios are now diversified more globally after a long period of U.S. outperformance.
Right.
And I think that Canada is getting some of that cash flow.
Okay, that is all the time we have, but so good to get your insight. Thank you so much for joining us.
My pleasure. Thanks for having me.
That is Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Up next, Canada looks to expand trade with Mexico. We will discuss the way ahead right after this. Stay with us. Canada is working to expand trade with Mexico as the two countries sign a trade memorandum of understanding, and a large Canadian business delegation visits Mexico. So what's the way ahead for trade ties between the two countries, even as the CUSMA trade agreement comes up for renegotiation? Joining us now from Mexico City is Shauna Hemingway, a former diplomat and now senior special advisor for Mexico and the Americas with the Business Council of Canada. It's good to have you join us. Thanks so much.
Thank you. Delighted to be with you.
So I'm wondering, first of all, what exactly does this new MOU do? What are some of the next steps, do you think?
It solidifies what has been a long-standing relationship that really the Business Council of Canada has invested in over, I'd say, the last 5 to 8 years. We're really seeing the opportunity and engaging with our counterpart, which is the Coordinating Council for Business in Mexico. And so under this MOU, we'll strengthen those business-to-business ties. We have already a CEO dialogue that has been well underway. And I think what we're seeing this year is an opportunity to ensure we have that public-private sector collaboration that will be critical in terms of building our collaboration going forward.
What is the framework for trade between Canada and Mexico? We don't talk about it as much as we talk about the framework between Canada and the U.S. Like, is most of it under CUSMA?
A lot of our trade, of course, happens under CUSMA. We saw an enormous growth after we signed NAFTA. So by 12-fold, we grew our two-way merchandise trade over this time. And what we've also seen is a huge influx of Canadian investment into strategic sectors in Mexico, where, strengthening the North America competitiveness in terms of other regions. What we're still waiting to see a bit more growth is in terms of Canadian exports to Mexico. And also, there's an opportunity this year, I think in particular, for us to bring up Mexican investors and have Mexican capital taking advantage of some of the changes and some of the shifts we'll see in Canada that will make us a more competitive and compelling investment environment.
Yeah, because it'd be interesting to see it because you're in Mexico from that standpoint, right? Like, what's the appetite there for greater trade with Canada?
I think Mexico has been looking to capture Canada's attention and to capture the attention of the business sector in Canada for many years. It's been growing incrementally, but what we need to do is really up our game this year and start to take a much more sophisticated look at the Mexican market. So the Mexican companies here are keen to engage. What we've seen as well from the Mexican government is a great deal of interest in establishing consistent and maintaining a dialogue with Canadian business. So we've had excellent opportunities to engage with the Sheinbaum government since she took office in October of 2024. And it's just been growing. And I think this year we should see a lot of the fruits of our labor paying off to the benefit of both countries.
What do Mexican businesses see as some of the greatest challenges and also opportunities when it comes to trading more with Canada?
They want to deepen the relationship. I think one of the biggest things we need to overcome is a lack of understanding. We have had this tendency to see each other through the lens of the United States and North America, which remains very relevant and certainly critical to both our futures. But we need to start to have a strategy for each other that really takes advantage of all the opportunities that still remain for us to invest in and look at. And what this will do is strengthen our North American competitiveness. So by Mexico and Canada putting a lot of investment into our bilateral pillar, we'll be able to create a North America that's much more dynamic, much more ready to compete with the world in 2026 and beyond.
And you said earlier that one thing that would be helpful to see is more exports from Canada to Mexico. Are there certain sectors that you think could be exporting more?
Absolutely. A couple of the sectors we have down here this week, in fact, includes agri-food, which is always very, very big. The Mexican government is looking to find quality, more affordable options. And of course, Canada can provide that. We have a very dynamic and interesting agri-food sector and agri-tech as well. Advanced manufacturing is a lot of our investment as well in Mexico, but in terms of communications technology, as well as some of the key sectors, for instance, in energy. So Mexico relies on the United States for 70% or more of its natural gas, and Canada can be a source, a second source to sort of bolster that up. So we're looking to export more energy products, and as well, they need to increase their storage here. So right now, they only have 2 or 3 days worth of storage, which is a vulnerability to their population, but also a vulnerability to business and investors. So Canada can provide some of that technology in terms of energy storage, and I think that we'll see a great area for growth going forward.
Okay, so just lastly, because we have this MOU today, we know a few hundred Canadian business leaders went to Mexico as part of this delegation. How optimistic are you that we'll see movement from this MOU?
I think we're already seeing movement, and I'm sure we'll start to see even more results. And then just in the next few months, as companies, they've been reporting back that they've had excellent meetings. A couple of companies have already said they've made plans to bring Canadian investors up to Canada as a result of this mission. So I don't think it'll take long. And certainly Trade Secretary Marcelo Ebrard has announced that they're looking to bring a delegation up to Canada as well. So that will be happening later this year, we hope.
Okay, well, to watch for that. That's all the time we have. Shauna Hemingway, Senior Special Advisor for Mexico and the Americas. Thanks so much for joining us. Appreciate it.
No, my pleasure.
Thank you. Up next, the annual rate of consumer inflation in Canada eased slightly in January. We will dive into that slowdown coming up right after the break. Canada's annual inflation rate fell to 2.3% in January, primarily driven by lower gasoline prices. Our next guest expects inflation to remain subdued, but anticipates that the Bank of Canada will remain on the sidelines for the time being. So let's welcome in Benjamin Tal, Deputy Chief Economist at CIBC. It's good to have you join us. Thanks so much.
A pleasure. Thank you.
So let's dig into that first point a little more. Inflation getting closer to that 2% target. You don't think that's going to move the needle at all with the Bank of Canada?
No, I think that, listen, inflation is not an issue when it comes to Canada at this point. In the US, it's different. It's still elevated. In Canada, we are okay. The Bank of Canada, in my opinion, has the green light to cut if needed. They will not, because they're telling us that they will not cut interest rates. But when people talk about interest rates in Canada rising in 2026, I don't believe it. I think that if there is a risk when it comes to interest rates in Canada, is that they actually will go down, not up, in 2026. But at this point, our call is that the Bank of Canada will do nothing until 2027, reflecting a weaker economy, clearly a relatively elevated unemployment rate, and inflation that is not an issue whatsoever.
Okay, so let's dig into the numbers a little bit more, because I'm wondering if there are any other categories here that actually contributed to the drop in inflation that we saw. It was a very slight drop.
Yes, we are talking about food prices. Food prices actually went up. Why? Because we got this GST, HST break last year. That will continue to be the case. Despite that, if you look at the 3-month moving average annual rate inflation, in core inflation, it's about 1.5%. So the more recent numbers, if you exclude food that is has a base effect, it's really going nowhere. So clearly, inflation is not a factor. Another factor which we have to look at is rent. Rent is a very important part of the CPI. And we know that the asking rent is actually going down in the country, especially in places like BC and Ontario. At the same time, on a year-over-year basis, the rent inflation, according to the CPI, is about 4.2%. I don't buy it. I think the number is much lower than that. So inflation might actually be lower than perceived.
So, okay, you don't buy it. I mean, shelter prices dropping. Do you think that's enough to stimulate kind of renewed demand in that sector?
Not yet, not yet. It will take at least a year or two. If you look at the condo market, for example, prices will continue to go down for the next year or two before they stabilize. Rent inflation will continue to weaken. And I think that they are not actually negative yet. They will be negative in the next few months when it comes to the average. So overall, it's not enough to solve our affordability issue, if you wish, but it's clearly a step in the right direction.
Okay, so let's talk a little bit more about gas prices, oil prices as well, because excluding gas, January's inflation rate was actually 3%. I'm wondering if you think the current oil surplus is creating a false impression that inflation is under control at this point.
Well, that's why we look at the core inflation as opposed to the total CPI, because it's dancing to the tune of oil prices that change all the time. Therefore, the Bank of Canada cares more about, if you look at inflation minus energy and food and all kinds of other items. And if you look at core inflation, what the bank is focusing on average in the last 3 months was 1.5%. That's why I think the Bank of Canada, if needed, has the green light to cut.
Okay, let's go back to food as well. You mentioned food prices off the top, obviously a big contributor to the numbers we're seeing today. Do you think we're going to continue to see food prices where they are, grocery prices? What needs to change, I guess, for Canadians to see lower prices at the grocery store, something a lot of people are always talking about?
Well, mathematically, it actually will go up over the next few months, because if you remember, we got the GST-HST break last year on food. So you go down and then you go up. So the spread is higher. Therefore, it's called the base effect. And this we will continue to see over the next few months. So don't pay attention to food prices rising. The level is relatively high, and that's a totally different story. And quite frankly, unfortunately, I don't see the level of prices going down, so you will have to continue to mortgage your house to buy a banana or something.
Okay, so you don't see anything there, any relief there. You see an expectation of continued moderate inflation. I mean, is this a time for Canadians to be panicking, do you think?
Nothing to panic about. The most important factor at this point is not inflation, is not even interest rates, is actually Trump. And I'm very optimistic about the situation with Trump. I believe the time is not on his side. We have a situation in which in November he's going to face the voters in the midterm elections. Time is not on his side. He will have to compromise. They are already talking about renegotiation of USMCA. And I do believe that the tariffs are here to stay, but they will be relatively low. I don't see tariff averaging more than 10% on Canada, which is totally manageable when it comes to the overall impact on the economy.
Okay, so that's optimistic. Just very quickly here, because we do have a little bit of time left, I wanted you to comment on the last quarter's jobs reports. It was negative. Did that impact anything that we're seeing today?
Not really, not really. Clearly, the economy is not strong. If you look at the overall GDP growth in the fourth quarter, it will be negative. The unemployment rate is elevated, especially among young people. And clearly, we have the labor market not moving in the right direction. Again, if people were talking about the Bank of Canada raising interest rates in 2026, I think they are absolutely wrong about that. The Bank of Canada will not touch interest rates, reflecting the weakness in the labor market. Youth unemployment is a very important issue, something that we have to focus on. And clearly, we need to keep interest rates low to provide some sort of energy to this economy, including, by the way, the housing market that is in a recession.
Mm-hmm. Absolutely. Okay, that's all the time we have. Benjamin Tal, Deputy Chief Economist at CIBC. Appreciate you joining us today. Thank you.
Thank you.
Up next, the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. Hennessy Capital Investment Corporation, the 8th, rings the closing bell at the New York Stock Exchange. Reckoner Capital Management is ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close today on Bay and Wall Streets today. TSX ended the day down by 0.5%. We saw kind of a drop off in gold, silver, oil prices. That's affecting the TSX today. Interesting day on the U.S. markets, though. The S&P 500, NASDAQ, both rebounding after a bit of a sell-off this morning. If we look at some of the big market movers on the TSX today, MDA Space was up more than 5% at one point, ended the day up more than 6%. This was one of the best performing stocks on the TSX today. On the flip side of things, Capstone Copper, one of the worst performing stocks on the TSX, ending the day down almost 6%. Elsewhere, some interesting stocks that we're watching today. Of course, we've been talking a lot about Wheaton Precious Metals. It was down, ended the day down more than 2% after signing a $4.3 billion silver streaming deal with BHP. And we're also watching shares of United Airlines. It was boosted today. It was up more than almost 5% to end the day, with Bloomberg reporting United saw the biggest growth among airline companies for the week ending February 8th. And that seemed to be instilling some confidence in some investors there. For more on the markets, let's welcome Tyler Elgard, president of Gradient Advisors, onto the show. Good to have you. Thanks so much for joining us.
Thanks for having me.
So it's an interesting day. I'm not sure what you make of what we saw with U.S. Markets in particular today, but obviously a lot of conversation around AI expected to disrupt, potentially dominate some industries like the software industry. But why have we seen tech stocks pulling back so much so far in 2026?
I mean, it's just the pure threat of AI taking over the capabilities of what those software services are offering, right? You can go to ChatGPT or Claude or Grok or any of the other ones that are out there, and you can ask it literally anything. Now, the question becomes, do they have the right answers, and are they the correct answers? So there has to be some knowledge there that you can't just ask it anything and everything. But the general sense is that AI can take over whatever the service is that these software companies are offering. And so that's why you're starting to see these software stocks actually pull back. And you can get into some of the other sectors as well that are pulling back off of the concern over AI and what it's going to do or potentially do. Mm-hmm. I'm not as concerned about that right now. I think we do have to see some of these companies punch back a little bit, if you will, in terms of how they're going to utilize AI for the consumer, how it's going to make their platform better, how it's going to enhance the capabilities of their platform for the user. So there is going to be some winners and losers, but I think generally speaking, I'm not as concerned about what the market is telling you for these software names right now.
And you say a lot of these companies, because as you mentioned, software in particular has been hard hit. We've seen this year, real estate, though, trucking as well, financial services. You say they need to punch back. How so? What should they be doing?
The type of investment that they're going to be making in AI to utilize on their platforms, or the growth trajectory of their firm or their company, despite the concerns over AI, right? All you hear about is what AI is going to be doing and the capabilities of it. We haven't yet really heard about how these companies are going to make their platform better or enhanced versus what the AI chatbots are going to be able to do right now. So that's what we really need to start seeing.
Do you think that's something investors should be cautiously kind of aware of at the moment?
Absolutely, yeah. It comes down to there will be winners and losers. And so you have to, again, the challenge of it is picking the winners versus the losers. But again, there will be winners that come out of this, the companies that do utilize AI or showcase that their platform is better than what AI can give you. There will be those companies, and those are obviously going to be the winners. Now, again, there will be some of the losers that might just rest on their laurels and not do the punch back that I'm talking about and just let AI take over what they're doing. Obviously, most companies will try not to let that happen. But again, there is going to be a big difference in the companies that are willing to put in the investment and showcase their platforms versus AI.
We've heard a lot about these, big like hyperscalers spending a lot in terms of AI. We've seen a lot of reports coming out, like quarterly reports, and AI spending is very big. A lot of investors cautious about that. Do you think the spending is justified, or do you think these big companies should also be cautious about how much they're spending?
I would say it's justified right now. Again, we don't know what the total return on investment is going to be in the next 5 to 10 years, but they have to spend to try to get a better return on investment. And so right now they are spending, and it is what it is. But I think at this point, it's one of those things where these companies aren't, especially the hyperscalers, aren't necessarily focused on the current capabilities of AI, right? We already know who the winners have been in the current AI space. What they're investing for is advancing AI forward into the artificial general intelligence, or AGI, and whoever can get there first is going to be the winner. Just like oftentimes right now when we talk about AI and chatbots and what is AI right now, I hear a lot of people talking about ChatGPT. It's just referred to as ChatGPT, just like Kleenex is referred to as tissues. So it's who is going to be the winner and who's going to get that return on investment first. That's what they're spending for right now. And so It's a lot. Don't get me wrong, but I think at the end of the day, they almost have to be spending this type of money right now.
Yeah, that's an interesting way of looking at it when you mentioned ChatGPT. Aside from this excessive AI spending that we're seeing right now, whether it's justified or not, what other factors do you think are contributing to the kind of market anxiety we're seeing right now?
Yeah, I think there's a lot of concern around U.S. consumers, number one. Some of the data isn't necessarily showing that consumers are we hear a lot of times U.S. consumers are struggling. We're not necessarily seeing that in the data, but we hear about it a lot on the lower end of the income cohorts. And so I think the markets are concerned about that and what the Fed could potentially do and where interest rates are going right now. The affordability, I guess I should say, is what people are concerned about, which is adding to some of this volatility in the markets, despite the jobs numbers coming in better than expected, unemployment coming down, all of the things that we saw last week. Despite all of that, there is still a lot of concern about U.S. consumers.
Do you think we're going to, I'm asking you to predict the future a little bit, but continue to see that concern when it comes to U.S. consumers throughout maybe the first half of this year? I
do. I think, especially, you have to bifurcate the consumers that you're looking at, right? Because the market is more about what the earnings potential are for the companies versus the economic side, where you could be having some of those lower income cohorts really having affordability issues right now in the U.S. And I think both can be true at the same time, where you get strong earnings growth, but you have some weakening consumer ends and the market continued to go higher despite the economic side of it. So I think the volatility in the markets and the concern over U.S. consumers continues at least throughout the first half, if not into the end of the year.
Okay. You also mentioned the Federal Reserve and rate cuts for the rest of the year. So I'm wondering what your prediction is in terms of what we'll see there.
Yeah, look, I've had to change my thought around this a few times here. And the reason being is coming into the year with some of the changes for the Federal Reserve and the board members, I was expecting more rate cuts towards the end of the year, call it 3 to 4-ish. Now I'm pairing that back with who President Trump is appointing as the Fed chair. That shocked me a little bit. Maybe that's the conversation for another time. But I think the Federal Reserve, I would say 1 to 2 cuts right now is the expectation on my end.
1 to 2 cuts. Yeah. Okay. We could talk for a lot longer, but that's all the time we have. Tyler Elgaard, president of Gradient Advisors. Appreciate your time. Thank you.
Thank you.
Coming up, Palo Alto is releasing its second quarter earnings after the bell. We'll have live reaction to that right after the break. Welcome back. Palo Alto has reported its second quarter earnings, and here's some of the results that we're getting in right now. A beat on earnings per share coming in at $1.03 versus an estimated 94 cents. We saw revenue increase 15% year over year for the company. Product revenue up 22% year over year. Subscription and support revenue up 13% year over year. And when we take a look at the year forecast, sees revenue at $11.2 billion. That's compared to $11.3 billion. And so we'll continue to dive into these numbers. Here to give live reaction and in-depth analysis to some of the reporting that we're seeing coming out of Palo Alto is Ivana Delevsky, founder and chief investment officer at Spear Invest, joining us now. It's good to have you join us. Thanks so much.
Thanks for having me.
So I guess, first off, when you're looking at this report that just came out for the second quarter, what are some of the big takeaways for you in terms of what you're seeing?
Well, overall, we think this is a very strong report. What we specifically are looking for is the next-gen ARR, which is basically their next-generation type cybersecurity solutions. And this is where the CyberArk acquisition ties in as well. And that's coming in above $8 billion, which we believe is very strong. The question here really for the stock is it's really getting tied into the software sell-off. And that's really why I think you're not going to see a strong reaction to the results, even though they're very solid.
Interesting. Okay, I do want to talk about that in just a moment, but you did mention CyberArk, so I wanted to talk about that acquisition because that's relatively new. I mean, what were your expectations when it comes to seeing how the CyberArk acquisition was going for Palo Alto?
Well, I think the positive this quarter was that the acquisition closed early. So we're going to be looking for more details to come on the call about metrics and synergies coming in the next year. But basically, the positive is that the deal closed early. So, and we think it's going to be very accretive for Palo Alto. They're going to really be able to leverage their existing installed base of customers and sell CyberArk solutions to them. And this is a very high growth area of cybersecurity where CyberArk plays. So I think this is going to be a long-term win for the company.
You mentioned that this company is kind of tied into that massive software sell-off we've been seeing so far this year. I'm wondering, how much do you think these numbers are affecting the stock? And is this relatively what it looks like a strong earnings report, maybe enough to turn things around?
Well, we're going to see about details from the call, but basically what's been going on in software is investors are concerned that a lot of these agentic AI tools are going to be able to replicate some of the very well-known software that we have today. And I think this concern is actually justified. So as a result, software stocks have been selling off to below 4 times revenues, which is really low compared to history. And then you have on the flip side, companies that we don't think will be affected negatively, like Palo Alto. The problem though with them is that they're trading over 10 times sales to EV to revenue. So I think that's really where the divergence now is too big to ignore, and that's really weighing on the cybersecurity stocks. I think once this resets, cybersecurity will be the place to look for ideas, because I think ultimately the numbers will get stronger and not weaker as a result of agentic AI. It's just a matter of we're in a place in time where everything is getting repriced.
Obviously, what we're seeing on the screen right now, shares of the company down in after-hours trading. What do you think that's about? Like, what do you think investors are maybe concerned about with this company?
Well, I think the concern is definitely valuation and how it stacks against the rest of software, right? When you're trading at above 10 times, expectations are actually very high. So we are not involved in the stock just because of that. I think we are expecting a broad software valuation reset. And then once that reset is done, you're going to be able to evaluate the numbers, the synergies, the potential revenue opportunities for these companies. But for now, it's a little tricky to invest in software. I think there is a lot better risk rewards in the hardware layer of AI, where there are a lot more obvious beneficiaries as things are getting built out.
Mm-hmm. Now, we talked about the acquisition of CyberArk. Palo Alto also announcing today that it's entered into a definitive agreement to acquire Koi. I'm wondering, with all these acquisitions, mergers and acquisitions, what do you think the impact of that will be?
Well, investors are a little bit skeptical about so many deals so quickly without us seeing the actual benefit. So that may be another question for management, this new acquisition. I think Palo Alto has had a very strong history of integrating these acquisitions and delivering synergy. The concern, though, now is, well, how much of this growth is organic versus how much you need to be paying for delivering outsized growth. So that's something to closely watch, because we do want to see organic growth at the end of the day from the next gen solutions that Palo Alto offers. And then on top of that, the revenues need to come in from some of these newer acquisitions. But it can't be just all acquisitions growth. Mm-hmm. And I think acquisitions will get a little more scrutinized, especially in the near term, until we see the benefits of them.
That's what I was wondering too, right? Like, it does seem to be a lot of M&As, and as you say, investors probably waiting to see what revenue comes from that. How long will they have to wait? And do you think there's like a time limit in terms of how patient investors will be?
Well, I think there is usually about a year that you need to wait for integration to happen and for synergies to start coming through. So I think as a patient, like, if there was no software sell-off, I think this would be an opportunity to look ahead of that, those synergies getting delivered. The problem, though, is that since you don't have the valuation support here, that makes it a little more tricky as an investment. So I would say it looks very interesting outside of this valuation reset that's happening in software. But once the dust settles and you have the synergies come through, I think the risk reward will be a lot more attractive.
Interesting. Okay, that's all the time we have. Ivana Delevska, founder and chief investment officer at Spear Invest. Thank you so much for joining us. Appreciate it. Coming up, Air Canada is reporting better than expected revenue, and we were joined earlier by the company's CFO to discuss this and what's ahead for its service to Cuba. More on that when we come back. Stay with us. Welcome back, and we're getting fourth quarter results now from TFI International, a trucking and logistics company. It seemed as though missing a lot of the estimates in this latest quarter. Adjusted EPS is $1.09 versus $1.19 year over year, estimate of 86 cents, so beat there. But revenue down 8% year over year. Logistics revenue also down 13% year over year. And truckload revenue was down 2.7% year over year, estimated at $663 million. So we'll continue to monitor that for you. In the meantime, shares of Air Canada are getting a lift after the company posted better than expected revenue. And this comes as the airline suspended flights to Cuba, citing a fuel shortage. So for more on this, we were joined earlier by John DeBert, CFO of Air Canada.
Continues to grow. But we also have very strong international presence in Asia, so Trans-Pacific is very strong as well. Don't forget, we operate out of 3 major hubs, so Montreal, Toronto, and Vancouver. We are an international airline by all accounts, equally strong in the Caribbean, southern destinations, continuing to open up Latin America. So a very well-diversified airline with clearly a lot of strength on the transatlantic network right now.
Yeah, it's interesting. According to Bloomberg, the Atlantic was 28% of your revenue last year. Canada was 24%. And then transborder to the States dropping below 18%. What about, is that category still under pressure with Canadians not vacationing in the U.S.?
We had clearly an adjustment in the spring of 2025. So that was the most impactful change. It was down about 12, 13% or so, has kind of stayed at that level now, really stabilized at kind of minus 10 to 15%, depending on the routes and so on. So I think, transborder stabilized. The real positive for Air Canada is we have so many options with our network, very agile ability to reposition aircraft. We've done that very well. We've opened up much more Latin America. The Caribbean continues to do well. So there's a great diversity. And I would say on top of that, corporate travelers still do travel through the U.S. quite a bit. And we also have a very strong Sixth Freedom traffic, which brings Americans through Canada to the world.
You got an upgrade in 2024 from S&P. You went up to BB from BB minus. Now, you'll update me if you've been upgraded since then. But you're still sub-investment grade. Does that complicate life for you as a CFO? It presumably increases your borrowing cost.
Well, I'd say that overall, we have a pretty balanced capital allocation strategy. We keep a low debt, right now about 1.7 times our earnings, so our net debt leverage. Our borrowing capacity is very strong. We get very, I would say, almost investment grade like cost of capital, to be honest with you. Aircraft are also very liquid, very strong assets, and therefore produce fairly competitive debt pricing when you do finance them. Right. So overall, I think we have a balanced approach here. We want to, 1, invest in the airline. 2 is we want to make sure we keep a strong balance sheet. And 3 is make sure that we return capital and cash to investors. And we've been doing all 3, I'd say, rather well, particularly since 2024 through 2025, and we'll continue to even do better in 26 and 27.
I know this is volatile and it's very dependent on capital spending, and you have been buying a lot of new aircraft. But according to Bloomberg data, your free cash flow dropped to about $750 million last year, and it was about $1.3 billion in 2024. Why was there that drop in free cash flow?
We're starting to ramp up our investment cycle. We're going to take on about 70 aircraft between here and the end of 2028. Last year was, I believe, 15 aircraft. We'll have another 35 aircraft delivered in 2026, and that'll continue through 27, 28. So we are going through an investment cycle. It will modernize our fleet. It'll also add so much more network capacity and optimization. In 2019, we were running at about 113 billion available seat miles, total capacity of our network. And in 2025, that'll be about 105 billion. So we haven't yet recovered back to our full 2019 levels, which leaves a lot of great opportunity for us to continue to grow. And that's where the investments are going. So at $750 million, still, 3.5% of revenues. Feel good about that. We deployed $1.3 billion to buybacks of $2 billion of total free cash flow generation in the last 24 months. We've managed our leverage to be, very competitive at 1.7 times, and we're investing in the fleet. So I feel very good about a balanced allocation of capital.
We're tight for time, and I'm sorry about this, but the Globe and Mail says that more than 90,000 air passenger complaints against all of the airlines are backed up in the system. Yes. It sounds like your industry is antagonizing a lot of customers.
It's a difficult process, and we acknowledge that there is some administrative burden and bureaucracy in there. I think it really needs solutions both with the regulator and the airlines together. We do our very best to process all these claims. These claims then sometimes do get re-administered at the CTA level. Technology needs to play a role, and I think smoothing out regulation so it's easier to apply and easier to interpret will also help. There's opportunities for everybody, and we would like to have less burden as well as anybody else. And clearly, we want our passengers to have a seamless experience when they deal with us. When we don't live up to their expectations, we do want to make sure that they're compensated properly. We do need to see some relief in the overall administration, and we want to be part of that.
Just remind, your job is complex, to say the least. You're dealing with a highly capital-intensive industry. Give us an idea, how many flights does Air Canada do each day right now? Can you give us a ballpark number?
I think it's about 1,300 flights in total every single day.
How many, sorry?
We fly 1,300 flights a day. It's a logistical beast, and 45 million passengers a year. And so it gives you a pretty good idea. It's 1,300, and we have an extraordinary workforce that honestly is on top of every one of those flights, and it's food on the plane, bags on the plane, get you to the destination, and we do this with a lot of commitment and conviction.
45 million people a year. And what would you spend most of your time on? Would you say, you personally?
That's a great question. I think it's really helping the airline navigate growth. We're in a growth cycle. It's a very fine balance, as you've well indicated, between managing a strong balance sheet, returning capital to investors, and being able to bring and deploy capital to the airline effectively. Spend a lot of time making sure that we're delivering on our 2028 objectives. We put objectives out with our Investor Day in December of 24. We're fully committed to creating value, but also creating an exceptional airline for our customers. And doing all of that requires work from an incredible team, and the management team here is phenomenal.
That was John Di Bert, CFO of Air Canada. Up next, a rebound in Canada's consumer confidence. Is it the start of a rally or just a good month? We'll discuss with Nick Nanos, Chief Data Scientist and founder of Nanos Research, right after this. The pace of home building across the country continues to see a slowdown. Canada's Mortgage and Housing Corporation says the annual pace of housing starts dropped 15% in January, with no near-term signs of a turnaround. The agency says it expects new construction to continue trending lower, impacted by trade and geopolitical uncertainty, high construction costs, weaker demand, and rising inventories. Shares of Sherritt International took a hit today. The company is reducing operations at its joint venture in Cuba due to fuel supply constraints. Mining operations are expected to pause within the next week. Now, the move comes after Sherritt received notification that planned fuel deliveries will not be fulfilled. There's no timeline for resumption at this point, and Sherritt says production will continue at its Alberta and Saskatchewan refineries, with inventory expected to last until mid-April. Wheaton Precious Metals is doubling down on its silver exposure with the acquisition of an additional silver stream on BHP's Antamina mine in Peru. Wheaton will pay BHP $4.3 billion US upfront in cash, making this the largest streaming deal in history. Once the transaction closes, Wheaton will receive 67.5% of all the silver produced from that mine. And BHP Group posted earnings for the second half of 2025 at the upper end of analysts' expectations. The Australian company's year-long effort to increase copper production and historic metals rally contributed to the results. Earnings from the miner's iron ore business also edged 4% higher. Today, BHP announced a $4.3 billion long-term silver streaming agreement with Wheaton Precious Metals. Over the long weekend, Janice Charette was named Canada's new chief trade negotiator to the U.S., a key appointment ahead of this year's CUSMA review. For more on that, we were joined earlier by Martin Cobb, Senior Vice President of Equities at Lauren Steinberg Wealth Management. He discussed what this means for Canada as it heads into a critical phase of trade talks.
There's a splitting of the roles. Previously, the chief negotiator and the ambassador was the same individual, and here we are. We split the role of the ambassador, who can do more of the schmoozing, I guess, and then you have a dedicated trade negotiator. So I think that's a very, very positive step forward in terms of negotiating with our neighbours to the south, but also bringing in an individual like Janice. Given her pedigree, given her competencies, etc., I think it's very good news. What will be tricky negotiations? Let's face it, they're not going to be easy.
It is a challenge, I think, for both Wiseman and Charette. Now, do you think they can work together in the way that you mentioned? What could possibly be some stumbling blocks for them? Do you think, sometimes can you get a two-headed monster as opposed to one person in control?
That's a very good question, Roger. And there is definitely the potential for that risk. But really the roles are quite, an ambassadorial role is quite different really than a trade negotiation role. And in some ways, maybe having them two together previously wasn't ideal. So, in terms of, the real getting into the grind of bashing out the trade negotiation, CUSMA coming obviously in July of this year, having someone who is solely focused on that and can kind of, neglect the whole kind of ambassadorial role, which is more as, say, whining and dining. That's maybe a little bit unfair. But in terms of more of the soft, touchy-feely stuff, she can focus on the actual trade negotiations. I think that's a positive step. And likely the benefits from that outweigh any of the risks of splitting those two roles and having two individuals, because I do think the roles are quite separate.
Oh, the life of an ambassador. Now, I imagine the soft talks are probably starting right now. When do you think it'll start getting a little more serious, or does it feel like they're serious now?
I think it has to get serious now. Obviously, we have negotiations going on with Mexico presently, bilateral negotiations in addition to what will happen later this summer. There's a lot of posturing, and I must admit, I would not like to be one of these individuals trying to discern what is the policies or the plans, for the U.S. administration in terms of going forward. And, so I think it starts now. I mean, it's only a few months away, but the real heavy lifting will get done when we get into to thrashing out, the minutiae of the details with these individuals. Hopefully we can have more transparency. I've said before, I do think the whole, we have the midterms year here, and we have, talk of affordability being the number one issue on investors' minds in the US, and tariffs are a tax on consumers. And so I'm hoping, although I wouldn't put too much faith in it necessarily, that will help with negotiations coming to something that is a little bit more sensible and recognizing the cost to consumers, cost to US consumers of the current tariffs on a number of Canadian products just don't make any sense.
Do you think Trump is seeing that? I mean, I know some Republicans are concerned about the midterms, and even just that talk about the not the Ambassador Bridge, the Gordie Howe Bridge down in the States from Windsor into Detroit being delayed possibly by Trump because he was upset about it. Do you think, and the reaction he got from the governor of Michigan, senators from Michigan, and all these other states, do you think he is hearing that, or is he just blind to it all?
You're asking me to get into the mind of
Absolutely. It's a Tuesday morning after a long weekend. Perfect time for it.
Yeah. The bridge story, Roger. I mean, I was scratching my head. What is the president of the United States of America doing talking about a bridge, between, joining Canada and the US? And then I realized that actually the chap who owns the Ambassador Bridge happened to be in the White House a few days before this decision was made. So you can read into that what you would like. But yes, I do think there's pressure starting to bear. You saw a number of the Republicans voting with the Democrats most recently in terms of trying to take away or not extend the powers of the executive branch in terms of imposing tariffs. So there's rumblings happening. There are Republicans in some swing states, starting to kind of question whether, the policies are sensible. And I think that'll just build more and more over time. Will that, however, be taken as something that is significant in the minds of the president? Who knows?
And you mentioned, of course, Mexico's. We may or may not be negotiating as three. We may be negotiating individual deals with Mexico and the U.S. Canada has that massive delegation going down to Mexico right now. Do you think that will bring anything? Will come of that? And what kind of an impact do you think that'll have on any of the talks coming up? Will this again get a bee in the bonnet for Trump?
Yeah, I mean, I think it's 1% of our exports go to Mexico. It's
about I think 56 billion. I think is what it's at right now.
Okay, and obviously a lot of those have to go through the US, which isn't helpful. I think the greatest fear is that Mexico would strike a deal with the US before we struck a deal with them. So I think partly we're trying to head that off, trying to position ourselves to have a good relationship with Mexico. I think we and Mexico both stand for the same kind of free trade, back to the kind of rules, world order, etc., that kind of thing. So I think it's more the concern of if Mexico was to strike something with the US, which was disadvantageous to us ahead of CUSMA negotiations, we would want to be ahead of that. So I think this is a proactive move by the Carney administration to get in front of that. But will anything significant come out of it? It's hard to see.
That was Martin Cobb, Senior Vice President of Equities at Lawrence Steinberg Wealth Management. Up next, a rebound in Canada's consumer confidence. Is it the start of an upward trend or just a good month? We've got more on that right after the break. Younger Canadians are leading a climb in consumer confidence as it climbed to its highest level since late 2024 when U.S. President Donald Trump threatened tariffs against Canada. That's the finding of the latest Bloomberg Nanos Canadian Confidence Index. And for more, joining us now is Nick Nanos, Chief Data Scientist and founder of Nanos Research. It's good to have you join us. Thanks so much.
Good to see you.
So you say consumer confidence not booming, but showing its first ray of light in over a year. What's behind this rebound that we're seeing?
Yeah, a glimmer. And, the thing is as you know, it's a diffusion index. So it's score out of 100. Oh.
Well, we can still hear you. Nick, can we still hear you? Okay, never mind. We can't still hear Nick. I guess we lost him. That was Nick Nanos, Chief Data Scientist and founder Nanos Research. We'll try to get him back for you. Sorry about that. Stay with us. We'll be right back in just a moment. Welcome back. We're going to get right back to that conversation on consumer confidence in Canada with Nick Nanos joining us now. He's Chief Data Scientist and founder of Nanos Research. Nick, hopefully your signal lasts for the rest of this conversation. So we were just starting to talk about the findings of this. You say it's a glimmer of hope, but we're seeing a bit of a boost in consumer confidence. What do you think's behind that?
Well, the thing is it's been a pretty flat line, trend line for more than a year when it comes to consumer confidence. So 53 is positive because it's just been so flat for the last while. The one thing that we do know, first of all, as you mentioned in the opening, that the confidence among younger people has actually increased from about 51 points on the 100-point scale to 59. So it's an 8-point jump. It's the biggest jump, and it's what's been driving this positive mood. We also know that in the last week or so that the Liberal government has announced kind of a GST relief in order to help people with the rising cost of living. And we know that young people have been most likely to report that they're struggling to pay for the groceries and housing. So maybe this little glimmer of hope has to do with the Liberal announcement, because the reality is on all other fronts, it's thin gruel.
Yeah, I was going to ask you what's behind that, but I guess you just laid out what you think could be behind that glimmer of hope for young people, because as you say, they usually feel the pinch of affordability a little more than other demographics. Were you surprised, at least, to see those numbers?
Yeah, actually I was. And, the thing is because young people have been the most pessimistic traditionally since the pandemic, because they've been feeling the stress of uncertainty when it comes to the economy. The other thing is that when we look at the changes over the last 4 weeks, the proportion of Canadians that believe the economy will get stronger has actually improved about 6 points, from about 19 to 25%, even though there's still a significant 4 out of every 10 think that the economy will weaken in the next 6 months. So it just looks like there's a combination of factors where people see relief in terms of GST and the cost of living. They see a proactive plan from the Liberal government. Whether anything will happen or not is a different story, but at least they're hearing that there's a very proactive plan from Mark Carney and the Liberal government in terms of building trade relations and trying to diversify the Canadian economy. I think you roll all those things up, and there's a little bit of, why don't we just call it short-term hope? Because at 53 out of 100, that's not bright. It just means that it's not as bad as it has been since November 2024.
And it is nice. I mean, as you say, like, it's not bright, but not as bad as it has been. It's nice, a bit refreshing to see some optimism among some Canadians. But as you mentioned, there's still some things to be cautious about, right? Like, Canada reported the biggest job loss since August last month. I'm wondering how likely that is, do you think, to maybe affect consumer confidence going forward?
Oh, absolutely. And, the thing is that the job security numbers have actually been quite fragile over the last year or so. There's been a little bit of an uptick on that front in the last 4 weeks. But, the thing is that when we look at the overall environment, people are still worried. They're still anxious. There's still a lot of anxiety. We don't know what's going to happen in terms of our trade relationship with the United States. That's all we know is things have to change. But what Canadians have been hearing, at least, is a steady stream of announcements from the federal Liberals and Mark Carney to try to pivot the Canadian economy to reduce reliance on the United States. The reality is the U.S. will always continue to be our most important trading partner, but it's about diversification. So maybe this is a bit psychological. It might not be real, but people are just feeling a little bit better, especially if you happen to be under 30 years of age.
And it seems as though, as you say, some of the plans that the Prime Minister is putting forward are maybe changing people's opinions. He talks a lot about diversifying trade. Does that factor into any of the confidence that we're seeing here?
I think it does, especially from a messaging perspective. The thing is, people judge governments based on what they hear them talk about and what they focus on and what they hear in the news. And for Mark Carney, regardless of where you stand in terms of the perceptions of him as the Prime Minister, the fact of the matter is he's been very proactive. He's been traveling around the world, doing trade agreements, spending money on defense, building new partnerships. And I think there's a little bit of a dividend in terms of consumer confidence. And, we have to think of the flip side. Many times if people are feeling less confident from a consumer perspective, they stop spending money. And, at least we're in an environment now where it's a little bit more positive than we have seen in more than a year.
Yeah, absolutely. You say, that people are feeling positive right now because of talk and maybe, not seeing action just yet. I wonder how long people's patience will go, like in terms of maybe not seeing things turn around as quickly as people expect. If you've noticed any trends in the past in terms of that optimism being dashed.
It's interesting. Last year we did a survey and we asked Canadians, when did they want to see results from Mark Carney? And I think the majority said that they wanted to see results by the end of 2025. Well, TikTok, we're now in 2026. The big question is how much leeway will Canadians give Mark Carney? The other thing is that many Canadians believe that Donald Trump is outside of the control of the federal government. It's outside of the control of anyone. And that the reality is that we are on the receiving end of whatever the president in the White House wants to say and do in terms of Canada-U.S. relations. So there may be a sense that Mark Carney is probably doing everything that he could possibly do in terms of a situation where he doesn't really have a lot of control, but that they're giving him credit for the effort at this point in time. But the big question is, people can easily turn, especially if we see job numbers at risk, if we see a rising cost in terms of the cost of living, and it wouldn't take a lot for this little glimmer of hope to be thrown back into, what do we call it, the pit of despair. That was a movie. I think Princess Bride, Pit of Despair.
I actually don't know, but I will take your word on that one. And hopefully we don't go back into the pit of despair anytime soon. But I take your point that there's a lot up in the air right now, and we'll have to wait and see what happens. That's all the time we have. Nick Nanos, appreciate your time. Thanks so much for joining us.
Bye-bye.
That's Nick Nanos, Chief Data Scientist and Founder at Nanos Research. Meanwhile, Canada's new defence industrial strategy announced today aims to divert defence investment toward domestic firms rather than U.S. contractors. So here to talk more about the initiative is Craig Stone, Emeritus Associate Professor of Defence Studies at the Canadian Forces College. It's good to have you join us. Thanks for your time.
Thanks for having me.
I wonder if you can just walk us through, first of all, the key highlights of this strategy that was announced today. What stood out to you?
So the first thing that stands out is the government has actually identified some sovereign industrial capabilities, which basically means they're capabilities that the government has said must exist in Canada. And there's a list of those in the strategy document. And that's a start state for an industrial strategy in terms of a government articulating to industry what it says it wants to have in Canada for the security of the nation.
Now, the Prime Minister said he wants domestic procurement to be 70% of overall spending. I'm wondering how likely you think that is, first of all, that goal, and just how much that affects, the supply chain in Canada.
So I guess 2 points to start with. It'll be 70% of stuff moving forward in terms of new procurements. Mm-hmm. And part of that 70% will depend on how the government ultimately decides what's a Canadian industry. So, for example, a company like General Dynamics Land Systems in London is a Canadian company, but it belongs to a U.S. prime. Is that a Canadian company or is that a U.S. company? And I think part of that will just depend on how the government decides what's a Canadian company as it's looking to prioritize 70% of defense procurement money to Canadian industry. And if they go kind of on the General Dynamics Land System as a Canadian company, even though it might have a U.S. prime because the activity is happening in Canada, I think the 70% is possible to grow over the long term. Whether they can get to there in 10 years, that's a kind of wait and see whether they can actually manage that.
Okay, got it. So really unclear on whether the Canadian government will decide on what is considered to be a Canadian company. Is that correct?
I don't know if it's unclear, but there's a gray area there right now in terms of how they're ultimately going to decide. And part of that would depend on the friction that will ultimately exist between the Canadian Forces and the Department of National Defence on terms of what military capability they want versus what economic impact and benefits the government's looking for, because there's always some friction at play between those two requirements. And so how the government decides that will have an impact in the long term.
Okay, the government also talking about domestically manufactured defense equipment, wanting more of that. How will that help the Canadian Armed Forces?
So it'll be particularly helpful in the longer term for supply chain and sort of long-term maintenance, because if it's actually manufactured here in Canada, it means the intellectual property is here, the maintenance can be done here, and you're not depending on a foreign supplier to actually have that ability to do the maintenance and provide the material that you need when you want it.
Okay. Now, among some of the initiatives announced today in this strategy, it's also going to aim to increase Canada's defense exports by 50%. I'm wondering, with that in mind, is there actually global demand for Canadian defense equipment, do you think?
So, again, for me, this is one of those gray areas. So the Prime Minister has spent a fair bit of time trying to expand trade relationships, including the defense space. So we're going to prioritize Canadian defense industries. A number of other countries are doing the same thing. So there's a space there around if everyone's prioritizing their own defense industries, you're then into a space of can you actually grow the economy? Now, there will be growth in the economy just as a function of the amount of money that the government's planning to spend on defense. The real issue is, can they come to fruition with the European Safe Agreement in getting Canadian companies to provide parts of the supply chain or complete weapon systems to a European nation. And that's what part of the European Safe Agreement is about. Canada will be treated as a European nation in that space. And the same applies for initiatives that the government's making in the Indo-Pacific area. But as I said, so part of this to me is it's the right words. It's a gray area because other nations are trying to prioritize their own defense industries as well.
It seems as though there still is a lot of gray areas right after this strategy was announced today. A lot of kind of kinks that need to be worked out in terms of how Canada is going to do this along with other countries. With that in mind, this seems very elaborate. So how realistic is these strategies that the Prime Minister announced today?
Well, I think it's realistic in the sense of what they're trying to do for growing the Canadian economy. And when you look at the sovereign capabilities they've identified, those are areas where Canada does have some strengths, or there are areas where we already actually have a capability to compete globally. But how you operationalize this, because the strategy's out, it says all the right things. What we need to see now is how the government's actually going to operationalize some of these initiatives, and will they come to fruition in the 10-year time frame that the government's looking at doing all of this. I wouldn't expect much in 2026 because some of this is going to take some time.
All right.
But it's all the right narrative.
That's all the time we have. But Craig Stone, Emeritus Associate Professor of Defense Studies at the Canadian Forces College, appreciate your time. Thank you. And thank you for joining us today on The Close.